Okay, guys, so welcome to tonight's class. So this is class 2 of the 8 core classes. And tonight we're going to be covering the weighted average cost of capital. The structure of the class is basically going to be the first few minutes, like about 20, 30 minutes, a recap, an overview of the weighted average cost of capital. And then in the last 60 minutes, we will work through a question paper or a question on WACC. The question we're going to cover is the assignment 2 of MAC 3702, question 1. I think question 1A, question 1B, sorry, is WACC. So we will work through that. But basically, the important aspect is to just have a big picture overview of WACC. So I'll take about 15-20 minutes to explain it. And if you remember on Tuesday, and I told you how you go about when you start studying, that you must, before you start a topic, run through the key issues of a topic. So although I'm going to go through it like in 20-30 minutes, you might just take the important aspects and like for 5 minutes before you start a paper, try to remind yourself of the key issues. Why that is important is because no matter which number of questions we cover, the way you're going to see the question in the exam will most likely be very different from what we're going to be covering. However, the principles being tested is exactly the same. So that is why you want to remind yourself of the key issues so that when you work through a question, your focus is on the issues of the topic, and that's how you'll be able to identify what you need to do and what is required of the question. So basically, there's like 3 important things you need to focus on in any topic. So for WACC, what are the 3 important things? The question you need to be able to answer is, what is WACC and why is WACC important? So those first 2, and then the third one is where all the meat lies. That is where the marks lie, and that is how to go about determining WACC. So to answer the first one, what is WACC? WACC is basically the weighted average cost of capital, but that's not what we're going to answer. So yes, WACC stands for the weighted average cost of capital, but what is WACC? WACC is basically the cost of finance to a business, okay? So that's important to understand. WACC is the cost of finance for a business. So when they want to make an investment into a project, into whatever one they want to buy an asset, or whatever it is they want to invest in from a business point of view. So when Sasol want to invest into building a plant, when Eskom want to invest into building a power plant, so whatever they want to do, there's going to be a cost involved, right? They need an investment. There's going to be a cost involved, and they're going to make some money from it. Now they would want to determine whether they should invest or not. So the WACC helps us to determine whether the WACC will tell us what is the cost to a business, and we will compare it to the return on an investment. So where a return of an investment exceed the WACC, the company will be generating money. Where the return of investment is less than the WACC, then the company will be losing money. Because think about it, your return is the money you are making. WACC, which is the cost of finance, is telling you how much money you need to pay out. And as a result, if the one is more than the other, you will either make a loss or you will be making a profit. So just take note of that. So that is basically what WACC is. In one sentence, what is WACC? WACC is the cost of finance for a business, okay? It's like the combination of cost of finance for a business. Now, the question is, why is WACC important? Why are we so fixated on WACC? So in financial management, WACC is an important number or area because it is used in various aspects of financial management. So typical ones would be, it is used in financial reporting. So most of us becoming accountants or going on to one or want to become a chartered accountant. So either typically, I mean, you can, there's different, how can I say, roles a CA can play, but typically you can end up in being in a finance department as a financial accountant or as a finance manager. So part of the job of a financial accountant or a finance manager is to prepare annual financial statements. And in some companies, they would have large PPE assets. And as a result, you will have to perform an impairment test. So when you perform an impairment test, one of the things you need to calculate is the recoverable amount. One of the recoverable amounts is the value in use. Now, within the value in use, the discount rate that's get used is the weighted average cost of capital. So when you want to work out the recoverable amount for a PPE asset or for goodwill or so forth, you're going to have to be able to determine you're going to need an appropriate discount rate. And generally, what they use as an appropriate discount rate is the WACC rate. And as a result, you're going to have to be able to calculate WACC. That is from a financial reporting point of view. From a financial management point of view, you might just look at, if you have a look at Cecil, right? And you somewhere, I can't remember, I Googled, and the Cecil CFO, the group CFO of Cecil says what is he or she's important tasks. So two stood out for me, and I can remember. One of it is to source the appropriate finance, and obviously, and the reason for that, they play most of the CFO's time is spent on sourcing appropriate finance. Why? Because when they make an investment, and you can just read their financial statements, just go through their financial statements if you have time, they will always talk about, they used to use the word WACC, they use a different terminology, but it still refers to the WACC. They use this WACC to make investment decisions. So they know their finance, their cost of finance is, let's say, 15%. So when they want to make an investment, and remember, the investments takes about 10, 15 years. They have to build a plant, which takes 10 to 15 years before they start really making money from it. So then they want a return. The investment needs to generate a return of 20%. Their WACC is 15, but they want a return that is 5% above the WACC rate. So in the real world, the WACC rate does get used. Just look at Cecil. So generally, the WACC rate gets used in companies that makes significant investments like Cecil, like Eskom, and so forth. So that is another important aspect why we get used. So for investment, long-term investment decisions. Also where it gets used, when you do valuations. So in a lot of asset managers, asset managers, they use different types of valuation methods. And if they do use the free cash flow method, then they also need the WACC rate. So those are the important places where WACC gets used. And I mean, there's a number of other ways it gets used, but what gets used is that. And when you so let's say you're going on, you want to become a CA, then you have to do training. So most people that go into training, they will go to an audit firm. As an audit firm, you may audit a company that has large assets and that has to perform impairment tests. So if you need to know whether the accountant performed the impairment test correctly, you need to know WACC in order to be able to audit it. So that is kind of the important aspects why WACC is so important. It gets used in the real world. And so if you are the person performing the calculation, you need to know how to perform it. And if you are the auditor checking, you're still going to need to know how to perform it in order to know whether the calculation was performed correctly or not. So take note, that is why WACC is so important. It's a big topic because in the real world, it is big. So that is the what and the why, okay? So now we come into where from an academic point of view, where all the marks lie, and that is, how do you go about calculating WACC? Now, in order to calculate WACC, there are basically three things that you need. Okay, so when we do the question, I will reiterate these points again so you can see what I mean when we do a question. But basically, when you calculate WACC, you need three things. What are the three things that you need? Number one, you need to identify the sources of finance. That's number one. Number two, you need to be able to calculate the market rate or the cost of finance. And then number three, you need to determine the weighting. So those are the three things you're going to need. The first thing you have to do is to determine the source of finance. Without knowing the source of finance, you can't do 2 and 3. Once you know, number one, the source of finance, then you can do 2 and 3. 2 and 3 can be in any order. I just always say cost of finance first and then the weighting. But it doesn't matter. You can do weighting first and then cost of finance. Does not matter. But the first thing that you have to do is first identify the source of finance. Once you've identified the source of finance, now you need the next two things, which is the weighting and the cost of finance for each source of finance. Okay, so that's very, very important. Now, when it comes to the weighting, there's different ways to determine the weighting. Okay, so there's two typical ways. One is the wrong way and one is the right way. But sometimes they're going to ask you to do the wrong way, and that's okay. But if they give you a choice, you must know which one to choose. Okay. So the weighting has to be the target weighting. It has to be, the weighting needs to be based on the target capital structure, the target weighting. Now, in most cases, the target weighting is not going to be given, because if they give it to you, it defeats the purpose of the principles they want to test. So that is why hardly ever the target weighting is going to be given. Where it is given is generally in a question where WACC is not the focus. Okay. So they may ask you, like in a valuation question, to calculate WACC, but because valuation is the focus, they will give you a lot of the stuff for WACC and you might just do a quick calculation. Okay, so then in that case, they will give you a target weighting. But in most cases, they're not going to give you the target weighting because it defeats the purpose of the principles they want to test. So how do we calculate the target weighting? So the general rule is the target weighting is going to be the current capital structure based on market value. Okay, so that is important to take note. So how do you determine the weighting? Is one of two ways: target capital structure. How do we calculate the target capital structure? It is based on the current capital structure from the balance sheet, but using market value. Okay, if you use the current capital structure of the balance sheet as is, then you are using book value. So remember, accounting is past information. Finance is always forward-looking. So when we want to use forward-looking information, we need market values. We can't use book value. So the second way, which is the wrong way, is the current capital structure based on book value. Some questions is going to ask you for that, and then you go because they asked you for it. But if they give you a choice and they're saying, here is the current capital structure, this is the market values, and this is the book value, you must know you should always use market value, because from a financial management point of view, we are forward looking. So just take note of that. But as you do more questions, we're going to reiterate this point over and over and over, so you will know it completely. Okay. Then now we know the three things we need to do: identify source of finance, identify or calculate market rate, and calculate the weighting. So now, what is the source of finance? This is the important one. What is the source of finance? What's very important to understand, the source of finance in your WACC calculation is your capital structure. So what is the company's capital structure? The company's capital structure is all its long-term sources of finance. Okay, so it's all its long-term source of finance. So the source of finance that you include in the WACC calculation is the source of finance that form part of a company's capital structure. So the question is, what is a source of finance that forms part of the capital structure? It is all the company's long-term source of finance. So now the next question is, what is the company's long-term source of finance? It's only twofold: equity and debt. So which equity? All equity. Which debt? Not all debt. It is only your long-term interest-bearing debt. So that's very important. So your source of finance in the WACC calculation is your capital structure, which is your long-term source of finance, which is equity and debt. But all equity and only long-term interest-bearing debt. Very important, very, very important. So what's going to happen? They're going to give you a balance sheet, or they're going to give you an extract of the balance sheet, equity and non-current liabilities and current liabilities. So which equity do you include? All equity. Now under non-current liabilities and under current liabilities, which liabilities do you include? Only the liabilities that are long-term interest-bearing debt. So your typical examples for equity is ordinary share capital and preference share capital. Your typical examples for debt, it is going to be bonds, debentures, and long-term loans. What's important to take note, it could also be preference shares. Preference shares could either be equity or debt. Okay, so just take note of that. So, for example, creditors, you hardly include. Bank overdraft, you hardly include. So any debt that is short-term, any debt that forms part of working capital, any debt that form part of the operation is not part of the capital structure because it's not part of long-term source of finance. So you must look out for those. So anyone that is short-term or operational or working capital, you do not include in the WACC calculation because it is not part of the capital structure. Why is it not part of the capital structure? Because it is not long-term finance. Very, very important, okay? Why I'm telling you this, because in another question, creditors can be part of a long-term finance. Like in the real world, some creditors do form part of long-term finance. So it is part of capital structure and therefore it is part of WACC. So if they are silent on it, you always assume it is short-term, okay? They have to specifically tell you, but just take note of that. So what you want to do, when you do your WACC calculation, you only include all equity and only the long-term interest-bearing debt. And then below the WACC calculation, you will tell them the other ones that was excluded and you tell them why. So for example, you will say bank overdraft and creditors have been excluded because it is short-term, therefore not part of the capital structure. You want to tell them that, show them that you know why you're including and why you are excluding. Okay, so I'm going to switch over into Google Sheets because I want to show you the different methods of being able to calculate the various items now. Okay. While I open up, do any of you have questions that you want to ask? Dane, Nonku, Sergio, Talita, any questions?
No, thanks.
Okay.
I'm all good. Thank you.
I'm just waiting for Just waiting for Excel to open up. Okay, while the thing open up. So remember we said there are three things. Identify your source of finance, then market value, market rate, and then weighting. Now to determine weighting, we're generally going to use the current capital structure using the market values. Therefore, basically what you're going to have to calculate is market rate, cost of finance, and market value. Why do you calculate market value? Because you need the weighting. So that's very important to understand. Okay, just wait a while. Oh, my PC is a bit slow. So, so basically, the way I go about doing this is I break it into three parts. Okay, to calculate market value, to calculate market rates, I break it into three parts. It is, two parts. It is ordinary share capital, and then the second part is preference shares and debt. The way you calculate the market rate, the way you calculate the market value for preference shares and debt is exactly the same. Okay, so I put under one heading. Then for each one, we must be able to calculate market value and market rate. Okay, so I'll show you now. Okay, here we go. Okay, you should be able to see Google Sheets. So remember, what we're going to need, we need to calculate WACC. Okay, so I was going to show you the WACC formula looks as this. So WACC equals, so I'm going to write out the formula, and as I write out the formula, I'm going to talk about it. It's going to look daunting, but after I explain it, you will see how easy the WACC formula is. Okay, so it may look daunting only because there's a lot of letters, but once we work through it, you're going to see it's actually very easy. And I want you to see it as easy. Tell yourself it is easy. Don't underestimate the power of the mind. Okay, so you need to tell yourself it is easy. Don't tell yourself it is difficult, because then it's going to be difficult. So I'm going to show you how easy it is. It actually is. And then you're going to see how it falls into the actual calculations. So this is the formula. WACC equals the cost of equity multiplied by the value of equity divided by the value of equity plus the value of debt plus cost of debt after tax multiplied by the value of debt divided by the value of equity plus the value of debt. So it's a lot of numbers, a lot of letters. So let's try to make sense of this. Remember I said that the WACC calculation, we need three things, right? So the way we set it up is in a table. So we're going to have sources of finance or components of finance, doesn't matter what you want to call it. Sources of finance or components of finance, same thing, okay? So source of finance, that's the first thing we need. Then I just start off with market rate, which is the cost of finance. And then we need the weighting, okay? So that's the third thing. Now remember, in most cases, the way we're going to have to calculate the weighting is by determining market value. So that is why we have this column over here. So if the weighting is given, there's no need to have a market value calculation or column. So just take note of that. So understand that the market value is only there to determine the weighting. And this will give us WACC. So the three things we need: source of finance, market rate, and the weighting. So let's have a look at this formula. So this over here, this square bracket refers to equity. This square bracket refers to debt. Remember, your source of finance is only equity or debt. So here you can see this square bracket is your source of finance, equity and debt. Yes, over here, we're going to put in the specific equity and we're going to put in the specific debt. But there's no need to write that formula out for each equity and each debt. This is a general formula to show that we need the source of finance for equity and we need the source of finance for debt. Okay, so that is your source of finance. Now we need the market rate. Here we go. That over there, KE, cost of equity, which is a cost of finance. We want the market rate of the cost of equity. So that is market rate over there. Then we have KD. KD is your cost of debt, which is for this column over here, our market rate. So the only thing is when it comes to KD, we say 1 minus T, we take it after tax. The reason why cost of debt is after tax, whereas cost of equity is not, is because of the following. The cost of debt is interest expense. SARS allows a deduction for interest expense. That is why we need to take it after tax, because there's a tax deduction. The cost relating to equity is dividends paid. There's no deduction for dividends paid. Therefore, we don't have a tax deduction there. That's why we don't say 1 minus T. So just take note of that. So far, we have that bracket over there, which is equity, that bracket over there, which is debt, which refers to your source of finance. Remember, your source of finance is your capital structure, which is your long-term source of finance, which is debt and equity. All equity and only long-term interest-bearing debt. KE is your market rate. KD is your market rate. KE, market rate relating to equity. KD, your market rate relating to debt. Now we need the weighting. As you can see over here, the weighting is basically this over here. That's the weighting. So what is it saying? Value of equity plus value of debt. That is telling you it's the market rate of all equity plus the market rate of all debt. That is basically the market rate of long-term finance. That is your capital structure. So what you can see in blue highlighted, that is the company's capital structure. So when we say equity over capital structure, we are saying what percentage of the capital structure is funded through equity. And that is what we're getting, the weighting of equity. Over here, once again, you can see VE plus VD is the same thing as the other side, which is the company's capital structure. So here we are saying what percentage of the capital structure is funded through debt. So this whole thing over here is the weighting. This whole, what did I just do over here? Yeah, okay, there we go. Should be right. Yes. So this whole thing over here is the weighting of debt. This thing over here is the weighting of equity. As you can see, we're saying V, which represents market value. Okay, so we will put in the market values over here. So try to see how this formula comes down into the three components: source of finance, market rate, and weighting. Okay, so just take note of that. Now remember, we said The typical examples of source of finance. Okay, so first source of finance is equity and debt, but we need to give the specific equity and the specific debt. So the typical examples is going to be ordinary share capital. It is going to be preference share capital. Remember, preference share capital could either be debt or equity. And then your debt, it would be debentures, what was the other one? Bonds and long-term loan. Okay, so that's all your typical ones. So you could have 3 debentures, you must list each debenture separately. You could have 2 bonds, you list each bond separately. You could have 5 long-term loans, you would list each long-term loan separately, because the market value of each long-term loan and the cost for each long-term loan will most likely be different. And then that is going to give us our WACC. So how do we get WACC? Basically, WACC is calculated as follows. Market rate times weighting. So WACC is market rate A times weighting, which is B. Okay, so that is how we calculate that over there. Now we need to know, how can we calculate market rate? How can we calculate weighting? Okay, remember the weighting we're going to calculate is based on market value. So we need to know how to calculate the market rate of ordinary share capital and how to calculate the market value of ordinary share capital. So let's go to the next sheet. So how do we do it? Okay, so remember we need market rate and market value. Remember, the only reason why we want market value is in order to determine the weighting. So here we're going to have ordinary share capital. Okay, so for ordinary share capital, there are 3 ways to calculate market rate. So here we're going to have market rate. There are 3 ways. So what are the 3 ways? Way number 1, in no particular order, as I'm just saying as it comes to my mind. So way number 1 would be the CAPM model, capital asset pricing model. Way number 2, or method number 2, would be the dividend growth model. Dividend growth, or the Gordon growth, dividend growth, Gordon growth, whatever you want to call it. Okay, dividend growth model. And number 3 would be bond yield plus risk premium. Okay, so those are the 3 methods. How are you going to know which method? Well, they're not going to tell you which method. You're going to need to know which method. How do you know which method? You're going to need to know the formula for each method. Once you know the formula for each method, that will help you to know what are the various variables that makes up the formula, and that is what's going to help you to be able to pick up within a scenario which method. So, for example, the formula for CAPM is as follows. Cost of equity equals RF, which is risk-free rate. I'm not going to put all the details because on the online campus, all the details are there. So you can just go read it up. Okay, I'm just giving a high-level overview. So risk-free rate plus beta, which is market rate minus risk-free rate. Okay, so remember, when you see a risk-free rate, when you see beta, when you see market rate, that's going to tell you, dear Dane, please use the CAPM model. That's how you're going to pick up. They're not going to say, dear student, please use a CAPM model. They're going to tell you that they're going to give you information, and you're going to have to use the information in order to identify which method to use. Okay, so for the dividend growth model, cost of equity equals, I can't remember, cost of equity equals D1 divided by V0 plus growth. Okay, so over here, How do you know if it's capping? If they give you a risk-free rate. The risk-free rate will generally be a long-term government bond. So the risk-free rate would be a long-term government bond. And if they give you two long-term government bonds, use the one with the longest period. So for example, they can give you a 10-year government bond and a 15-year government bond. You use the 15-year. Why? Because you're trying to work out the cost of equity. Equity is basically forever and ever. So therefore you use the longest period. Beta will be given. So if you see beta, then you must know it's most likely capping. And then they give you the market rate. Generally, the market rate would be the average share price on the JSE or the top 40 share price of the JSE. So whenever they give you an average of the share price, then you use that. But just one thing to take note. This bracket over here, RM minus RF, market rate minus risk-free rate, that represents the risk premium. So it's very important to identify whether they're giving you the risk premium or whether they're giving you the market rate. Because if they're giving you the market rate, then you must say market rate minus risk-free rate. But if they give you the risk premium, please don't subtract the risk-free rate because it's already the full bracket. Just take note of that. Many people make that mistake. So be aware on what they are giving. Over here, D1 represents the dividend of the next period. So it's very important to ask yourself, are they giving you the dividend of the next period or are they giving you the current dividend? The current dividend would be the dividend recently paid, or they'll call it current dividend, or they'll say the dividend recently paid. That is not the dividend of next year. You want the dividend of next year. So you must identify which dividend they are giving you. This over here is the value, the share price today. Okay, not next year's share price, the share price today. V0 means current. Now D1 means next year. And then the growth rate. Okay, so they may give you the growth rate or they may give you information to calculate the growth rate. Okay, that's important. The question is, how do you calculate D1? So D1 is equal to D0, the current dividend, the most recent dividend, multiplied by 1 plus the growth rate. Okay, so just take note of that. This one is the very easy one. So they're hardly going to give it to you. When do they give it is like I said, for example, you're doing a valuation question or you're doing a capital budgeting question, then they just, by the way, test, WACC, then they will use this method. In the real world, this method gets used more often. They don't use these methods in the real world. Well, they do, but more often, and because I've seen quite a few, I wasn't an investment analyst, but I've seen quite a few. My wife is an investment analyst, so I see it. And then they mainly use the bond yield plus risk premium. Okay, so how you calculate this? Cost of equity equals bond yield plus risk premium. Okay, so in most cases they're going to give you the risk premium and they'll give you the bond yield. Bond yield is the current market price of the bond, market rate of the bond. Okay, so those are the three methods. So how do you know which method? They're not going to tell you. You need to know the formulas. First, you need to know the three methods. Then you need to know the formulas. Once you know the formulas, that triggers what are the variables within the formula. So for capping, what's the variable? Risk-free rate, beta, risk premium, or market rate. So if they give you those information, it's telling you, dear student, use capping. If they are giving you dividends, whether it is current dividends or next year's dividends, and you have a share price, and they give you growth, or you're able to calculate growth, then it's telling you use the dividend growth model. Okay, so just be aware of that. So that is market rate. Now we come to market value. So for market value, there's basically like 7 methods, but you must only know those methods when we come to valuations. So for WACC, there are 2 methods, okay? Once again, I'm just gonna say there's no order. Okay? I'm just whatever comes to my mind first. So method number one would be market capitalization. This is the most common one when it comes to WACC, but they also test this one, so you need to know both. Okay, and that's going to be the dividend growth model. So just a point to note, if you are using the dividend growth model to calculate market rate, then you can't use the dividend growth model to calculate market value. And vice versa, if you're calculating market value using the dividend growth model, then you can't use the dividend growth model to calculate market rate. And I'll tell you why just now. So those are the two methods. So this is going to be value equals number of shares in issue. So very important, number of shares in issue, not authorized shares. Okay, so remember, authorized shares is the number of shares that the company can issue in its entire life. Issued shares is what's currently in the market times share price. Okay, so just take note of that. Dividend growth model, we're using the exact same formula, but obviously now we have to rearrange that formula. So value equals D1 divided by cost of equity minus G. So as you can see, so why can't we use, if you're using the dividend growth model to calculate market value, you can't use it to calculate market rate. Why? Because we need the market rate if you want to calculate market value. Similarly, over here, we need market value. So therefore, you can't use a dividend growth model to calculate both the market rate and the market value. It can only be calculated for one of the two. Okay, so you might just be aware of that. So those are the two methods. Okay, once again, how do you know which method? The first thing you do, you must run the methods through your mind. Market cap, dividend growth model. Run the formula through your mind. So once you know the formula, that will then trigger what are the variables needed for the formula. And that once you know the variables needed for the formula, that will help you to be able to pick up which method to use within the scenario. Okay, so just take note of that. Okay, so that is ordinary share capital. So next, we're going to do preference share capital and debt. Okay, so the way we go about doing this is exactly the same for preference share capital and for debt. So over here, the first thing you need to do, the very first thing you need to do is firstly identify what was given, because either the market rate or the market value will be given. Okay, so whichever one is given, most likely the other one will need to be calculated. Okay, so that's the first thing you do. What was given? So once you know what was given, that means the other one needs to be calculated. So generally, the market rate is given and you need to calculate market value. But either way could happen. Okay, that's the first thing. The second thing you need to do, now you know what you need to calculate. So most likely you're going to have to calculate market value. But either way, whether you need to calculate market value or market rate, what you need to do first is to identify whether you have a redeemable instrument or a non-redeemable instrument. I use the word instrument because we're referring both to preference shares and debt. So I don't want to say redeemable debt or redeemable preference shares, because that's why I use the word instrument, because preference shares and debt are both instruments. Okay, so the first thing you need to identify for the one you need to calculate whether it is redeemable or non-redeemable. Okay. So the question is, how do you know if it's redeemable or non-redeemable? If there is a specified date of repayment, if it is redeemable. If there's no specified date of repayment, then it is non-redeemable. Okay. So if there is a specified date of repayment, it is non-redeemable. It is redeemable. If there's no specified date of repayment, it is non-redeemable. Okay, so that's important to take note. So what do we do? So if it's non-redeemable, meaning there's no specified date of repayment, then we use the perpetuity formula or the perpetuity formula. The perpetuity formula, so market rate, market value. So we use the exact same formula. That's why one must be given and the other one will be calculated. So for market rate, what is market rate? KD or KE, but I'm going to call it I. Okay, so I is the market rate equals PMT divided by market value. Okay, so just take note of that. That's the formula. So if there is no specified date of repayment, we have a non-redeemable instrument. And for a non-redeemable instrument, we use the perpetuity formula. The perpetuity formula to calculate market rate is I, meaning the market rate, whether it's preference shares, whether it is debt, equals PMT, payment, divided by market value. So market value is the market value of the debt instrument or the preference share instrument. Payment is either interest or dividends. So if it's debt, it will be interest. If it is dividend, if it is preference shares, it will be dividends. If you need to calculate market value, we use the exact same formula. We're just going to rearrange the equation. So over here, it's going to be value equals PMT divided by I. Okay, so that's important to take note. So once again, value, market value, that's what you want, equals PMT, which is payment. So it's either interest for debt or dividends for preference shares, divided by I. I is the market rate of the debt instrument or the market rate of the preference share instrument. How do you know if it's the market rate? If they tell you the similar rate in the market is whatever, so when you see the word similar, then you must know that is the market rate or the market value. So just take note of that. So that is non-redeemable. So if it is redeemable, that means there is a specified date of repayment. So generally what we will do, we will use the financial calculator. Okay. So you can go look into, go read the more details on the online campus. You should have access to the course. But just so I'm going to show you. Using the financial calculator, once again, if we either need to calculate the market rate or the market value. So when we use the financial calculator, we use it 5 buttons on top on the financial calculator. So the market rate, the unknown is I. Okay, so I is the unknown. That is the market rate. That means we need the other 4 buttons, which is present value, future value, PMT, and I. Okay, so that is basically, once again, exact same thing for market value. Exact same thing for market value. If it's redeemable, we will most likely, not always, but more likely than not, I'll look for a question. I just need to find which question. It's definitely a question where we don't use the financial calculator. We don't use the 5 buttons of the financial calculator, but in most cases we do. Okay. So once again, we want the market value. Sorry, not I, N. So when we want to calculate the market value, then PV is the unknown. Okay, then PV is the unknown. So that's why I leave that on top. So that means we need the other items. Okay, so for market rate, we need I. For market value, we need PV. Okay, so that's the unknown. So I is the market rate. PV is the market value today, current market value. Okay. Okay. This here is the future value. The way you calculate future value, in most cases, the future value is lump sum plus premium. Okay, so the future value is lump sum plus premium or minus discount. Okay, we will come across lots of questions like this, and the videos you're going to watch will have plenty of this. Payment, this is payment. So payment is fixed regular payment. Okay, so it's a fixed regular payment. If there's no fixed regular payment, then you don't have PMT. How we calculate payment? Payment is lump sum, sorry, this is nominal value. Nominal value. Nominal value, or another term for it now, nominal value or face value. Okay, so future value is lump sum payment made at the end of the period. So you have a 5-year period, there's a lump sum payment made in year 5. Okay, then you have a future value. Okay, payment is nominal value times coupon rate. Now this is very important. Okay, you must distinguish between coupon rate and market rate. The market rate is the rate you will get in the market today. It is that similar rate that they will refer to. The coupon rate, that is the rate that you and the financial institution agreed upon. Okay, so when you take out a loan, that rate in the agreement, let's say 10%, that is the coupon rate. That is the agreed upon rate. That is the rate that the bank or the financial institution is going to use to calculate how much you must pay them. So just take note, distinguish between the coupon rate and the market rate. And this here is remaining number of payments. Remaining, not total number of payments, remaining number of payments. Okay, how we calculate that? It is remaining number of years multiplied by number of payments or compounding periods. Number of payments per year. So for example, you have a 5-year loan and you make payments twice a year. So N is number of years, 5 years, times number of payments per year, 2 per year. Therefore, N is 10. Okay, so just take note of that. But remember, it's always the remaining number of years. Okay, so let's just copy this. Same. Okay, so that is basically, that's it. Yeah, there we go. Okay, so as you can see, there's a specified date of repayment in telling you what's the remaining number of payments. So that is why we can use a financial calculator for redeemable. Okay, non-redeemable, there's no specified date of repayment. That's why we use the perpetuity formula. The perpetuity formula goes on forever and ever. Okay, so that's it that I wanted to cover in terms of the theory. I know it took a bit longer than normal, but this is quite important. Okay, so now we're going to use this to work through a WAC question. But before we work through the WAC question, I sent an email, which is assignment 2. of MAC 3702 for the ECP students that they wrote sometime in June. So you can just let me, if you have any questions, I'm going to open up that in the meantime. If you can also open up on your side, while we open it up, can you, Jeff, do you have any questions you want to ask me? Is anything unclear? Is there anything you want me to re-explain, or yeah, whatever, or any question you may just have? Dane, Sergio, Nunko, any question? Talita?
All good, all good.
I'm okay, I'm all good.
I'm just opening at my side. Closed it. Okay, so I'm just opening up, so I closed it by mistake now. So we will go through that question now. What I'm going to do, I'm going to give you guys just like 5 minutes to read it on your own. Only question one. I'll tell you. I'm going to quickly get it open. Okay, yes, busy opening my side now. So I only want to read. I'll tell you which question now. Okay. So you received the email from me with the question, right? So here is the ECP paper. Okay. Here's the ECP paper, question 135 marks. So it's a short scenario. Yeah, so quickly take 5 minutes to read it, and we're going to answer this question over here. Okay, so we will answer part B. Cool. So quickly read question 1. I'll come back in 10 past, and then we're going to do the question. Okay, so you guys should be done reading it now. So let us read it together, and then we're going to answer the question. Okay, so here we go. So here's this question 1, 35 mark question. We're only going to do part B. We will use this assignment throughout the course. So they say Tech Savvy Limited, TSL, is a technology innovation company based in Cape Town. The company focuses on developing technological solutions which are key to making modern workers more productive. TSL is listed on the Johannesburg Stock Exchange and has several branches across the SADC region. Okay, so take note, they are a listed company. Okay, so it's important to pick that kind of stuff up in financial management. So they say during 2020, TSL identified several areas where blockchain technology can be used in the health, property, education, supply chain, and other sectors. Blockchain is a system of recording information in a way that makes it difficult or impossible to change, hack, or cheat the system. It is essentially a digital ledger of transactions that is duplicated and distributed across the entire network of computer systems on the blockchain. Any change made in the ledger has to be accepted by all the other users across the network, making it virtually impossible for fraudulent transactions to be effected. TSL has received support and interest from the government of South Africa by way of a grant from the Technology Innovation Agency for the research and development of a pilot solution for the Department of Health for the recording of patient information. Following the success of the pilot project, TSL has pitched the adoption of the blockchain technology to several potential users and received very positive feedback. TSL plans to set up a blockchain development unit in order to deliver on the blockchain revenue stream. The following information was sourced from the integrated annual report of TSL. Okay, so basically there's just a lot of background information, nothing really important. What could be important in a financial management question would perhaps be strategy as well as risk management. Okay, so they could use that paragraph for strategy and risk management, and then you need to talk about certain stuff. But for our purposes, not relevant at this point in time. Okay, so now we have the extract of the statement of financial position at 31 May 2021. So here they're giving you equity and liabilities. When you see that, it could either be a WAC question or source of finance question or both. Okay, so here they have equity and liabilities. We have ordinary shares, so it's 80 cents each. So they're telling you it's 80 cents each, and we know the total amount. So that will tell you, you'll be able to work out how many shares are in issue. Then we have retained income, and this gives us shareholders' capital. Okay. Then we have preference shares, which is 100 Rand each. So that will tell you how many shares are in issue. And then we have a long-term loan, an FNB bank, 16.67. So this here is the coupon rate. This is the rate agreed upon between TSL and FNB. This is the rate that FNB is going to use to calculate how much interest TSL must pay them. Okay, so there we have our total equity and liabilities, which is 2 million Rand. So now they're giving us additional information. So they're saying ordinary share dividends declared and paid in the previous 5 years were as follows. So they're giving us dividends, okay, for the previous 5 years. When you see information like this, they're telling you that you need to calculate the growth rate. So what you must know is that there are 3 methods to calculate the growth rate. All 3 methods are on the online campus. Okay, the third method, you don't have to worry about that, hardly tested. So you don't have to worry about that. But the other two are important. And one of the two we're going to use over here. That's going to be the most common one that we're going to use. Okay, so just be aware of that. So when you see a list of information for a number of years, then you must know they're telling you calculate the growth rate. So here even further. TSL board intends to maintain the average growth in dividends. Okay, so where do we use the growth rate? Generally in the dividend growth model. Okay. Here they're telling you the market share price for ordinary shares is currently at 12 Rand per share, and the preference shares is 96 Rand per share. Okay, they're saying new issues will have no effect on these prices, although ordinary share issue costs will be 4% per share issued. So this share issue cost hardly comes in, but they do bring it in an assignment because you have extra time to go read the textbook what to do with share issue costs. So I'll show you what to do with share issue costs. Okay. So there we go. So here you can see they're giving you the share price. Okay, so they're giving you the share price. When they give you the share price, and you know the number of shares. Remember, we can calculate the number of shares because we are given that 80 cents and we know the total amount. So that means we can calculate the number of shares in issue. So that is telling you that for the market value of shares, use the market capitalization method. What is the market capitalization method? Market value equals number of shares in issue. We can use, we have that, and times share price. We were given the share price. Okay, so now you can start thinking how to calculate the market rate of ordinary share capital. There are three methods: bond yield plus risk premium, CAPM, and the dividend growth model. There's no information so far on CAPM. There's no risk-free rate. There's no beta. So that means we probably can't use CAPM. But there is information relating to the dividend growth model. We can calculate growth. We have the number of shares in, we have the market price of shares, and we have dividends. So that means we most likely going to have to use the dividend growth model. Okay, so that is how you pick up. So you may not get it now, but as you work through questions, that is how you're going to be able to pick up which method to use. Okay, then they say TSL aims to maintain a debt equity ratio of 1:1 going forward based on book value. You will see what's the reason for that. That is basically for question 1A, which deals with source of finance, which we're going to cover next week. Okay, so it's not applicable for this question. It's not applicable for what we're going to do today, which is WACC. They say to service the new blockchain technology clients, TSL is planning to buy new high-tech coding infrastructure of 800,000 Rand at the start of the new financial year. The company will use this infrastructure for 5 years and then scrap it for 50,000 Rand. Once again, you're going to see the relevance of that. Not important for the WACC. It's going to be important, I think, for part C or part D of the question. Okay, then they say the following options are available to finance the new initiative. Okay, so that's not important to us at the moment, but so we're not going to still bother with that. Yeah, okay. The only one that's important is here, a top-up loan from FNB Bank of 50,000 Rand at the same rate as the existing loan, which is considered approximate the fair interest rate. Okay, so the market rate is the same, so we're okay. So just take note that 16.67 above, that is the coupon rate. But they are telling you that the rate of the existing loan, which is considered the same as the market rate. So the 16.67 is the coupon rate and is also the market rate. So just take note of that. Okay, so this section over here, 0.5, this is we're gonna use this when we deal with part A next week, source of finance. Okay, so you can ignore that. Okay, then they're just telling you the South African tax stipulates a company tax rate of 28%. and an allowance on new coding infrastructure of 20%. The prime lending rate is currently 10% and is expected to stay unchanged for the foreseeable future. The required rate of return on preference shares is 11%. Okay, so that is just basically for the rest of the question. So now let's look at the required. So part A, this is the source of finance question, and we will deal with the source of finance question next week. Okay, so I think it's scheduled for next week, Thursday. Part B, this is what we want to calculate. Calculate the weighted average cost of capital based on market value. Based on market value after the financing of the new project. So after financing of the new project. So what I'm going to do, I'm going to ignore the new project financing. Okay, so I'm going to ignore it. The reason being is we need to do part A first. So because we're not doing part A first, I'm going to ignore. So then once we do part A, then I will update the WACC calculation to answer exactly over here. Okay, let's say for this part, assume preference shares are non-redeemable. Okay, so that is fine. So that means that it's non-redeemable, meaning we must use the perpetuity formula for the preference shares. Okay, so just take note of that. So now let's go and answer WACC. So remember, I'm not going to use after the financing. Once we do part A next week, then I will update part B, or I'll do part B again. So just take note of that. Okay. So this here is MAC 3702 ECP assignment. Assignment 2. Okay, so remember, practice, practice, practice. But what's more important, you're not going to do a run through a million questions. Okay, you don't want to run through a million questions. 3 to 5 is enough. If you still can't do it after 3 or 5 questions, then it's not, doing more questions is not going to help you. Then fundamentally something is wrong. So if you still can't do WACC after 3 to 5 questions, then remember, doing 10 questions is not going to help you. Fundamentally something is wrong. Then rather contact me so that we can see where the issue lies. So remember, on Tuesday, I explained to you how to work through questions, right? Follow that approach. That is what's going to help you by just doing 3 to 5 questions. That's going to help you to actually get a good understanding. And when you do your 3 to 5 questions, follow the way I do a question and try to use that approach to answer. That's how you're going to develop your understanding and how to think through a question. If after 3 or 5 you still can't do it, then contact me so that we can work through where I sit with you alone, or not sit, but where I work with you alone to see what the issue is. Because like I said, if you can't do after 5 and you want to do 10, you're still not going to be able to do it after 10. So fundamentally, we need to sort out something. Okay, so just take note of that. So for me, what do I do? When I read a question and I see calculate WACC, the first thing I do is, or not the first thing, so when I come to answer the question, the first thing I do when I come and answer a WACC question, I write down the formula. You don't have to write down the formula. There's no mark for the formula, but I write it down. Cost of equity multiplied by value of equity divided by value of equity plus value of debt plus cost of debt after tax multiplied by value of debt divided by value of equity plus value of debt. Okay, so there's my formula written down. So number one, when I come answer after I read the required and I know I must calculate WACC, then I'm coming to answer the question, I first write down the formula. You don't have to write down the formula, okay? But from this step onwards, you have to do. So the next thing I do is I set up the WACC table. So what's the WACC table? Source of finance or components of finance. Market rate or cost of finance, market rate. We must use market value. So I put in market value. My market value helps me determine my weighting. And then I have WACC. Okay, so number one, write down the formula. Number two, set up the table. You can start by just doing the table. You don't have to do the formula. Okay, so set up the table. Next, I identify and I put in my source of finance. So step three, identify my source of finance and then put it in. But remember, while I'm reading the question, I'm already identifying my source of finance. So we identified there is ordinary share capital. Okay, you write the full thing. There is preference share capital, and then there's the FNB loan. This is going to change when we do part A. Okay, so there's going to be a change when we do part A, but for now, I'm assuming we didn't do that 800,000 Rand investment. Okay, so those are my three sources of finance. Okay, so that is, so step number one, formula. Step number two, table. Step number three, identify and slot in the source of finance. Now we do step number four, is to calculate market rate, to calculate market value. Okay, so now we go about doing the calculation. What you want to do, you always want to, when an examiner opens up to part B, they mustn't see workings. They must see the answer. So whenever they come to, so what you must do, you start a question on a new page. So part A, start on a clean page. Part B, start on a clean page. Don't do part A and part B on the same page. Start on a clean page, okay? Then, when they look at your answer, when they see part A, when they see part B, when they see part C, they must see the answer, not workings. Okay, so here's my answer. This is my answer. Okay, it's not workings. My workings is on a separate page. So here I do my workings on a separate page. So my separate page starts over here. Okay, so here's my separate page starting. Don't underestimate the presentation of your answer. Don't underestimate the presentation. You don't know when they're marking your paper. Okay, they could be marking it 2 o'clock in the morning after they have watched the Champions League. Perhaps their team lost. So what happens when people is in sorrow, they drink. So they may not be they may have a few whiskeys or whatever. So they might not be straight. So you don't know what they're doing. So that is why you want to make it easy for them to mark your paper. So the presentation of your question, of your answer, you must already think about presentation now already. So when you go into the exam, there's no thinking of presentation because you have already developed it now. Okay, so now I'm going to start with working one. Okay, so for me, I'm going to do market value first. So I'm going to calculate market value. So to calculate the market value of ordinary share capital, remember what goes through my mind? There are two methods. Method number one, market capitalization. Method number two, dividend growth model. The formula for market capitalization is number of shares in issue times share price. The formula of the dividend growth model is value equals D1 divided by equity minus growth rate. So I asked myself, what was given? Well, number of shares in issue was given, or I can calculate it, and the share price was given. So that means I can use the market capitalization method. So the market capitalization method, that's what I'm going to use. Value equals number of shares in issue times share price. Okay, so that's what I'm going to do. So what did I do? I ran so I'm training my mind. So when I'm calculating the market value of share capital, I run both through methods through my mind. And I'm telling myself what the formula is. And I'm telling myself what the variables for each formula is. Very important. Please make sure you do that. Train your brain to think in a certain manner. So by the time you write your exam, everything is automatic. Remember, what you feed your conscious mind ultimately ends up in your subconscious mind. Most of our thinking comes from the subconscious, or most things happen through the subconscious mind. Our breathing, our blinking of our eyes, what I'm saying, and all of those type of stuff happens from the subconscious mind. 90 to 95% of all activity of our body is run by the subconscious mind. If the conscious mind had to run it, we'd have been dead, because the brain is processing so much information per second. Our brains wouldn't be able to handle it if it wasn't for the subconscious mind. So, but the subconscious mind can only feed back what you fed it. The subconscious mind is like a hard drive. You can only get information what's on the hard drive. And basically, you have the power to install stuff onto the hard drive. So what you want to feed the subconscious mind, train it how to think. So how I train, or what I suggest you do, is that when you think about WACC, you go step 1, put in the formula. Step 2, set up the table. Step 3, identify the source of finance. Now, you need to calculate the market rate for each source of finance. You need to calculate the market value for each source of finance. So I'm doing market value of ordinary share capital. So what I train myself is that the formulas available for market value for ordinary share capital is 2. Market cap, dividend growth. Then I run the formula for market cap and I run the formula for dividend growth through my brain. Then I tell myself, what are the variables for market capitalization? What are the variables for dividend growth model? So I'm training myself on those 3 levels. So when I read a scenario, because I've trained myself to think in a certain manner, when I read a scenario, while I'm reading, the subconscious mind is going to identify stuff. So that while you are reading, even before you read the required, you're reading the scenario, you're already going to be able to pick up what the potential question is, and you're going to be able to pick up, if it is WACC, how you're going to calculate ordinary share capital, how you're going to calculate preference share capital. But it all comes with, when you are studying, you're studying deeply, you're studying properly. You're not just running through questions to get it done. Remember, you're going to know when you are done with a question whether you actually learned. You're going to have that feeling within you whether you actually learned. You may tell yourself that you went through 1 question, we went through 5 questions, but you're going to know truly whether after the 5 questions you have actually learned. Whereas if you just do 1 or 2 and you do it properly, that feeling is going to be there that I've actually learned. So do less, but do it properly. So that's what you're going to train yourself over the weeks. So by the time you come to that final exam, you're going to walk in with total confidence, because your mind is already, your subconscious mind already knows what it needs to be thinking about when you read certain stuff. You have stored it already, but the subconscious mind not going to work the night before the time. So you need to start now. Okay, so that is how you're going to do it. So when we calculate market ordinary share capital, the two methods. I ran the two methods through my brain. I ran the formula through my brain. And once I knew the formula, the variables popped up, and that told me what was in the scenario, what meets those variables, and that's how I picked up. It is market capitalization. Okay, so now I just need to go calculate it. So that means I need number of shares and I need share price and I need value. I mean, that's going to give me value. Okay, so what do I do? The number of shares, remember the number of shares I must calculate. It's going to be equity divided by par value per share. Okay, so the equity was 500,000. Equity was 500,000. The par value was 80 cents. So the number of shares is that. The share price was, I think, 12 Rand. Just check if I'm right. This was given. Okay. Okay, and then this is going to give me my value. Okay. Okay, so that's going to give me my value. So the formula is equal that number of shares in issue times share price. So that is my market value. Okay, so my market value is that over there. Remember, they're going to mark my answer. They're going to mark my answer. My market value could be wrong, but I don't want to lose my marks. So what do? I reference my workings. Okay, so I reference my workings. So there I'm referencing my workings, so they'll be able to go pick it up. Okay, so now I'm going to do working 2, which I'm going to do the market rate of, ordinary share capital. So the market rate, now I'm calculating the market rate of ordinary share capital. When I want to calculate the market rate of ordinary share capital, I tell myself there are 3 methods: CAPM, dividend growth model, bond yield plus risk premium. Then for each formula, I run through my mind the formula. Then for each formula, I run through the variables applicable to each formula. Now I do this every single time I do a WAC question, so that like now, for me, it's automatic. I already know because I've trained my brain to think in a certain manner. So I'm not thinking anymore. The subconscious mind is feeding me with what I've stored. So the same thing for you. Train your brain to think in a certain manner. Train your brain that when you're calculating ordinary share capital, cost of equity, tell yourself the 3 things, the 3 methods. Tell yourself the 3 formulas. And then tell yourself the variable for each formula. Do it over and over. You're going to see automatically it's going to come to you because you're training your brain what you want it to know. So that is what I basically would do. And then so through that, I would be able to identify, okay, now I know the variables. So what is in the scenario that matches those variables? Like I told you when we read through the scenario, it picks up dividend growth model. So I will write down the formula for the dividend growth model, which is cost of equity. Cost of equity equals D1 divided by V0, value today, plus the growth rate. So what do? I'll say D1 V0, D1 V0 and growth. So now I need to go fetch those numbers. So let's have a look. Let's go back to the scenario. Okay, so if I go back to the scenario. So remember, they want me to calculate the weighted average cost of capital. Okay, so I'm going to assume for now, I'll have to read this with more detail. It's very important to identify the date we need to calculate WACC at. So I'm going to assume the date we need to calculate WACC at is not clear in over here. So I'm just going to use that date for now. Okay, we will figure out the date again when we do when we start from part A. So I'm going to assume the date we are using is 31 May 2021. So 31 May 2021 is the current date. So 31 May 2021 is the current date. Very important. So they're giving us dividends for 2021. So this dividends for 2021, that is not D1. That is the current dividend, D0. So we need to use that to calculate D1. So what I'm going to do, I'm going to go back to the scenario. So working 3, D1 equals D0 multiplied by 1 plus the growth rate. So therefore, I'm going to need D0, I'm going to need G. Okay, and that's going to give me D1. So I know D0. So say current dividend equals dividend, this is just for sideline for you to know, equal dividend 31 May 2021. Okay, so that was given as 105.20. Okay, so it was given as, just check again, was 105.20. It was given as 105.2. Oh, that's cents, so I'm going to convert it into rands. So that is cents, so I'm going to convert it into rands. So all I'm going to do to convert it into rands is 100 cents in 1 rand, so divided by 100. Okay, so that is my dividend. Now I need growth. We know growth was not given. Okay, we know growth was not given, but we got information to calculate growth. So working 4. So growth is going to come from working 4. Now on the online campus, you're going to see there's different methods. Okay, so you're going to have the linear method and you're going to have the compound growth method. The linear method, to calculate growth, you can only use the linear method if it is 2 years. So last year and this year. If they give you a number of years, more than 2 years, then you must use the compound growth formula. You have to use the compound growth formula. So that formula works as follows. So the formula works as follows. So growth using the compound growth formula. Why are we using the compound growth formula? Because it gave us a number of years. Okay, so it is latest year, which is 2021, divided by earliest year. I can't remember what was the earliest year now. I'll check now. Earliest year to the power. So the way you use to the power on Excel or Google Sheets is that thing over there. 1 divided by n, number of years, minus 1. Okay, so that is the formula. Okay, so to get growth, we're going to need latest year, which is 2021. We're going to need earliest year, which was, I don't know, which was 2017. We're going to need n, the number of years, and that's going to give us growth. Okay, so that's going to give us our growth. So let's put it in. That's what we want. So the dividend in the latest year is equal to 105.2 divided by 100. Okay. The dividend in the earliest year was 2017, and that was given as, what was that given as? It was given as 72 cents. Okay, so 0.72. So 72 divided by 100. Okay, now this is important. How do you determine n? N is not 2017, 2018, 2019, 2020, 2021. N is not 5 years. The way you calculate n is as follows. From 2017 to 2018, that's 1 year. From 2018 to 2019, that's 2 years. From 2019 to 2020 is 3 years. From 2020 to 2021 is 4 years. So n is 4. Okay, so n is 4. Remember this thing over here, that represents to the power of as an exponent. So it's to the power of. So just take note of that. So when I want to calculate G, I'm going to say equal, open up bracket, latest year divided by earliest year. Okay, I'm going to close the bracket. Then I'm going to say to the power of, open the bracket, 1 divided by n. Okay, so what I will do, I'll put this entire thing in brackets. Shucks, what you just do? What you just do here now? Okay, so I'm going to put this entire thing in brackets. Just close that. Okay, and now I say minus 1. So my growth rate is whatever that is. It is 9.94%. Okay, so just take note of that, 9.94%. So now I can calculate D1. So D1 is equal to D0 multiplied by 1 plus the growth rate. So that is D1. So the dividends of next year is whatever that number is, 156. So now I can plug it in. So I'm going to have working 3. So working 3, it is that over there. Growth is working 4. And now I must calculate the value. So remember the share price they told us is 12 Rand. Okay, that's what they told us. But in this question, there's an extra part we need to do. Okay, so remember they said if you issue new shares, you still will issue it at 12 Rand, but there's going to be a share issue cost of 4%. So what we need to do, we need to multiply by, we need to reduce the share price by 4%. Because what's going to happen? You're going to issue 1 new share. The person's going to pay 12 Rand, but you're not going to get 12 Rand. because you have to incur a cost of 4%. So therefore, what you're actually going to get is 12 Rand multiplied by 96%. Okay, so just take note, you're only going to get 11 Rand 52, because the shareholder that buys the one share is going to give you 12 Rand, but you're going to incur a cost of 4%. So the net amount you're going to get is only 96%, which adds up to be whatever that is, 11 Rand 52. So now that I have all the variables, I can now calculate cost of equity, KE. So KE equals D1 divided by the value plus the growth rate. So so cost of equity is 19.8%. So this is going to be equal to C26. Okay. There we go, 19.6%. And I'm going to tell them they can go look at working 2. So I put working 2 first, because working 2 relates to market rate. Working 1 relates to market value. So what I'm going to do, I'm going to stop over here. So I want you to revise this. And then by Monday, you must send me if there's any questions that you have on this. I'll upload this tomorrow. Then I want you to have a look through, watch through the video that we went through and work through this. Try to get the 19, try to get the 7.5. Start now to develop the thinking approach, so that when you do any WAC question, it's going to be automatic the way you think. Okay, so I'm going to stop over here. There's a lot that we went through, and then next week I'll continue and we will do the source of finance question as well. So by Monday, send me feedback in terms of what you learned up until here. Okay, is that okay with you guys? I'm not going to go further because I think there's a lot, and I have a class actually at 7:30, but I'll start at 8 with the other class now. Do you have any questions before we call it a night? Dane, Sergio, Talita, any questions?
All good. Yeah, I'll work through it, and then if there's any feedback, then I'll just pop you a message.
Okay. Dane?
Can I just see that cell that you did with the when you took out the issue cost?
Yeah. Okay. Sure. So I said 12 Rand.
Okay. Oh, okay. You just times it by the 96.
Yeah.
Okay, I understand.
Okay. Manku, you have anything on your side? Oh, shucks.
No, it was a lot to take in. So are you going to send us the video of this class?
Yeah, so I'm gonna upload it on the platform. So I'll do it by tomorrow. So tomorrow I have a dedicated slot where I'm going to just sort out that, put up the videos and stuff on the platform. So remember when you registered, you got an email with your password. So you're going to use your email address plus that password to log in. So what you'll do, go to www.eduance.co.za. You'll see this student login. You press login, put in your email address, put in the password that you should have received via email. And then you'll come up to a thing called My Account. You'll click Enrolled Courses. Then under Enrolled Courses, you should have MAC 3702. Click on MAC 3702, then all the content will be there. But this, I must still upload these stuff. Okay.
Okay, thank you.
Okay. Talita, anything your side?
No, I'm fine, thank you.
Okay, so please work through this and try to get it right. Remember, this is WAC. WAC is always going to be like this. So when I say always, as I mean a lot going through. So start with a thinking approach as you work through it. Develop that thinking approach, because remember, there's 3 methods just to calculate cost of equity. 3 methods. For each of those 3 methods, there are different variables. For each of those variables, you may need to calculate. You could already see we calculate dividend growth model. This is one of the methods. The 3 variables are those 3. For each of those 3 variables, it was not given exactly. You needed to calculate it. You needed to calculate growth. you needed to make an adjustment to whatever market value, and you needed to calculate D1. So as you can see, that is why it becomes a lot. But when you work through an approach to thinking, your brain will know how to navigate all of these issues, and it'll make it in a manner that becomes easy. But remember, it's not going to become easy after day one. It's going to become easy by the time, if you work through, by the time you write your exam, it's going to be what you call it. And I mean, like the guys that wrote ECP, those of them that got the results, 4 of them got the results. Others are still waiting on the result. The one guy doesn't want to look at his results. He's going to look tomorrow. Other guy never got his results for some other reason. So 4 people got the results. And from the four that told me, I'm assuming the other one didn't want to tell me because it wasn't as great. The 3 passed, right? And I asked them for feedback. And it is basically, I never suggest thousands of questions. And it's basically the thinking approach, how you think through a scenario. But when you practice, so the way I went through a question, that is a suggested approach. Remember, I can't tell you I can't force your brain to think in a certain way. Only you can force your brain to think in a certain way. And I'm not saying this is the only way, but it has proven to work. So whatever way you approach, all I'm saying, don't memorize. Don't try to work through questions, hoping that working through 100 questions is going to help you in the exam. Work through less questions, but do it on a quality basis. Try to work out a way of how you're going to think through something. That is going to help you to write the exam, because by developing a thinking approach, you are basically getting a deep understanding of what you are doing and why you are doing it, and also how you are doing it, so that when you come to a question, no matter what they're giving you, you will be able to handle it. Okay, I have to go now. So I'll see you guys on Tuesday next week. Just make sure that by Monday you give some feedback if you have time over the weekend to work through this question. Okay. When I say feedback, I mean, you must tell me what you have learned and what is still challenging or confusing for you. Okay. Okay, guys, I'll see you. Bye-bye.
Thanks, Louise.
Thank you.